Hi, everyone, this is the Encyclopedia channel. Faced with a stock, how do you determine whether it has investment value? A concept is involved here, stock valuation, which can be used by investors to assess whether the stock price is reasonable, and then decide whether to buy, hold, or sell the stock. So, what is stock valuation? What are the common methods of stock valuation? Stock valuation is the process by which investors evaluate the price of a stock with the goal of determining the intrinsic value of the stock. It calculates the value of a stock through different valuation methods and models based on fundamental analysis of the company, industry analysis, and market expectations. Stock valuation is crucial for investors because it helps to judge whether a stock is undervalued or overvalued and provides a basis for investment decisions. So, how do we determine whether a stock is worth investing in? This requires us to value stocks through the price-earnings ratio method, asset method, cash flow method, and other methods introduced below. Price-to-earnings ratio method, stock valuation. The price-to-earnings ratio method is a commonly used stock valuation method, which compares the company's market price with its earnings per share ratio to assess the valuation level of the stock. The price-to-earnings ratio is an indicator that compares a company's market capitalization with its earnings per share. The formula is: the price-to-earnings ratio equals stock price/earnings per share. Among them, the stock price refers to the stock price in the market, and the earnings per share refers to the company's net profit per share. The price-earnings ratio can reflect the market's expectations of the company's future profitability and investors' sentiment and confidence in the company. Through the price-earnings ratio method, investors can judge whether a stock is undervalued or overvalued according to its price-earnings ratio level. Generally speaking, a low the price-to-earnings ratio may mean that a stock is relatively undervalued, while a high the price-to-earnings ratio may mean that a stock is relatively overvalued. However, the effectiveness of the price-to-earnings ratio method depends on several factors, including industry characteristics, the company's growth potential, and earnings quality, among others. Here are some key points to keep in mind when using the price-to-earnings ratio method to value stocks. Classification of the price-to-earnings ratio. The price-to-earnings ratio can be divided into static the price-to-earnings ratio and dynamic the price-to-earnings ratio. The static price-earnings ratio is calculated based on the company's profit in the past year, reflecting the company's past profit level. The dynamic price-earnings ratio is calculated based on the forecasted earnings for the next year, reflecting the market's expectations of the company's future profitability. Interpretation of the price-earnings ratio. The specific interpretation of the price-earnings ratio varies from case to case. Generally speaking, a low the price-to-earnings ratio may indicate that the stock is undervalued and investors can obtain relatively high returns. But a low price-to-earnings ratio may also reflect the market's pessimistic expectations for the company or challenges it faces. A higher the price-to-earnings ratio may indicate that the stock is overvalued and riskier. However, a high the price-to-earnings ratio may also reflect high market expectations for the company's future growth potential. Limitations of the price-earnings ratio. The price-earnings ratio method has certain limitations and cannot be used as an independent stock valuation indicator. It ignores important factors such as the company's financial status, growth, industry competition environment, and macroeconomic factors. Therefore, when using the price-earnings ratio method, investors should conduct comprehensive analysis in combination with other indicators and methods to draw more accurate valuation conclusions. In order to better understand the application of the price-earnings ratio method, we will illustrate through several cases. Case 1. Company A and Company B are two companies in the same industry. Company A trades at 10 times earnings and Company B trades at 20 times earnings. In the preliminary analysis, we may think that Company A is relatively undervalued, while Company B is relatively overvalued. However, further research finds that Company A has a lower earnings growth rate, while Company B has a higher earnings growth rate. Taking this factor into account, we can conclude that Company B's high the price-to-earnings ratio likely reflects investors' expectations of its higher growth potential. Case 2. Company C is an emerging technology company with a price-to-earnings ratio of 100 times. Despite the high the price-to-earnings ratio, Company C has significant advantages in its innovative technology and market leadership. In addition, the overall growth potential of the industry is high. Therefore, a high the price-to-earnings ratio may be justified, reflecting investors' high expectations for Company C's future growth. Case 3. Company D is a company in a traditional industry with a price-to-earnings ratio of 8 times. Despite a low the price-to-earnings ratio, Company D has stable earnings and a healthy financial profile. In addition, Company D operates in a highly competitive industry with limited growth prospects. Therefore, the low the price-to-earnings ratio may reflect the market's pessimism towards Company D. These cases illustrate that the application of the price-earnings ratio method is complex, and other factors need to be considered comprehensively. In particular, investors need to pay attention to its limitations when using the price-earnings ratio method. Using the price-earnings ratio alone to evaluate stock valuations may cause deviations. The price-earnings ratio is an indicator of stock valuation. In practical application, investors should comprehensively consider multiple factors, including industry prospects, company's profit quality, financial stability, market competitiveness, industry prospects, growth potential, and other factors. In addition to the price-earnings ratio method, investors can also combine other stock valuation methods, such as cash flow method and relative valuation method, to obtain a more comprehensive stock valuation analysis. In addition, investors should also pay attention to the long-term trend of the market and the macroeconomic environment, as well as the company's future growth potential and innovation capabilities. The price-earnings ratio method is only a part of stock valuation analysis, and investors need to comprehensively consider multiple factors to conduct a comprehensive risk and return assessment. When using the price-earnings ratio method for stock valuation analysis, investors should also pay attention to the following points. Comparing companies in the same industry, the price-earnings ratio method is more suitable for comparing the valuation levels of companies in the same industry. Companies in the same industry have similar business models, competitive environments, and growth potential, so comparisons of the price-to-earnings ratios are more comparable. Consider growth potential. A high the price-to-earnings ratio doesn't always indicate that a stock is overvalued and may reflect investors' high expectations for a company's future growth potential. Therefore, when using the price-to-earnings ratio method, investors should focus on the company's growth prospects and innovation capabilities to fully assess its valuation level. Financial quality and stability. The price-to-earnings ratio method ignores the financial quality and stability of the company. Investors should also pay attention to the company's financial statements, debt position, and cash flow to ensure the company's profitability and financial health. Macroeconomic factors. The application of the price-earnings ratio method should also consider macroeconomic factors, such as inflation rate, interest rate level, and policy environment. These factors can have an important impact on a company's profitability and market valuation. It can be seen that the stock valuation price-earnings ratio method is a commonly used stock valuation method, which evaluates the stock valuation level by comparing the ratio between the company's market price and its earnings per share. When using the price-earnings ratio method, investors should comprehensively consider multiple factors and conduct comprehensive analysis in combination with other stock valuation methods to make accurate investment decisions. Assets method. Net assets method. The assets method analyzes the company's balance sheet to calculate the company's net asset value, or net asset value per share. Investors can compare the net asset value to the market price of a stock to determine whether a stock is undervalued or overvalued. Suppose the net asset value per share of stock B is $30 and the market price is $25. This means that the net asset value of stock B is higher than the market price, may be undervalued, and is worth considering for investment. Cash flow method. The cash flow method is based on the company's operating activities, investment activities, and financing activities of the cash flow to carry out valuation. Investors determine a company's intrinsic value by calculating the company's free cash flow and discounting it. Assume that the free cash flow of stock C is 50 million yuan per year, using a discount rate of 10%. By discounting the future free cash flow back to the present value, the intrinsic value of stock C is 50 million yuan / 10% equals 500 million yuan. Relative valuation method. The relative valuation method is to judge whether a stock is undervalued or overvalued by comparing valuation indicators between different stocks, such as price-to-earnings ratio and price-to-book ratio. Investors can choose companies with similar characteristics to the target stock for comparative analysis. For example, the price-earnings ratio of stock D is 25, while the average price-earnings ratio of other companies in the same industry is 20. This means that the price-earnings ratio of stock D is relatively high, and it may be overvalued, so it is worthy of vigilance. In addition to the common methods mentioned above, there are other valuation methods, such as stock option pricing model, earnings discount model, etc. According to different situations and investor needs, you can choose an appropriate method for stock valuation analysis. Let us understand the specific application of the stock valuation method through 4 practical cases. Stock valuation case study, Apple. Apple is a world-renowned technology giant, known for its innovative products and strong brand influence. We can use the price-earnings ratio method, asset method, and cash flow method to value Apple. First, according to the price-earnings ratio method, assume that Apple's price-earnings ratio is 30, while the industry's average price-earnings ratio is 25. This could mean that Apple, with its high price-to-earnings ratio, is relatively overvalued. Second, using the asset method, assume that Apple's net asset value per share is 50 yuan, and the market price is 60 yuan. This means that Apple's net asset value is below the market price and relatively overvalued. Finally, according to the cash flow method, it is assumed that Apple's annual free cash flow is 10 billion yuan, and a discount rate of 8% is used. By calculating the present value of cash flow, the intrinsic value of Apple is 10 billion yuan / 8% equals 125 billion yuan. Combining the above 3 methods, we can draw different conclusions. Although the price-to-earnings ratio method shows that Apple has a high price-to-earnings ratio, the relative valuation method and the cash flow method show that it is relatively overvalued. This may indicate that the market has high expectations for Apple's future growth potential, resulting in a relatively high stock price. This case illustrates the differences between stock valuation methods and highlights the importance of considering multiple factors together. When conducting stock valuation analysis, investors need to comprehensively consider the results of different methods and combine other factors, such as industry prospects, competitive environment, and macroeconomic factors, to make a comprehensive judgment. Stock valuation example, Amazon.com. Shares of Amazon.com Inc., one of the world's largest e-commerce companies, have been in the spotlight. Through stock valuation analysis, the price-to-earnings ratio method and relative valuation method can be used to evaluate the valuation of Amazon Corporation. According to the price-to-earnings ratio method, Amazon.com Inc. has a high price-to-earnings ratio and may be considered overvalued. However, the relative valuation method needs to consider the company's position in the industry and growth potential. Amazon's dominance in the e-commerce space and continued ability to innovate may make its relative valuation more reasonable. This case highlights the differences between different industries and companies, and the complexity of stock valuation that needs to take into account multiple factors. Stock valuation case study, Google Inc. Google Incorporated is the world's leading internet technology company, and its stock is also closely watched. Through stock valuation analysis, one can use the price-to-earnings ratio method, cash flow method, and relative valuation method to evaluate the valuation of Google Inc. Based on the price-to-earnings ratio method, Google Incorporated trades at a high price-to-earnings ratio and could be considered overvalued. But the cash flow method and the relative valuation method need to consider Google's dominant position and continuous innovation ability in the internet advertising market. These factors may make Google's relative valuation more reasonable. This case highlights that investors need to comprehensively consider the company's competitive advantages, industry status, and growth potential when conducting stock valuation analysis. Stock valuation case study, Tesla Inc. Shares of Tesla Incorporated, a world-renowned electric car maker, have been in the spotlight. Through stock valuation analysis, the valuation of Tesla Incorporated can be assessed using the price-earnings ratio method, cash flow method, and relative valuation method. In terms of the price-to-earnings ratio approach, Tesla Incorporated has historically traded at a high price-to-earnings ratio and may be considered overvalued. However, investors' optimism about Tesla is based on its leading electric vehicle technology, global market expansion, and sustainable energy solutions. Therefore, the relative valuation method and the cash flow method may be more suitable for evaluating Tesla's valuation. Relative valuation compares Tesla Incorporated to other companies in its industry. A high the price-to-earnings ratio might be more justified if Tesla Incorporated had higher growth potential and innovation capabilities among its peers. The cash flow method can be used to calculate Tesla's intrinsic value by analyzing its free cash flow and discount rate. Tesla's high growth and future earnings expectations may support a higher intrinsic value. This case highlights the peculiarities of Tesla Incorporated, whose high price-to-earnings ratio may reflect investors' high expectations for its future development. When investors conduct Tesla stock valuation analysis, they need to comprehensively consider the company's industry status, technological advantages, and market potential. The above 4 case studies show the stock valuation of different companies and emphasize the importance of comprehensively considering multiple factors and methods. Stock valuation is an important tool for investors to make investment decisions. Through the understanding of company fundamentals and market environment, through stock valuation analysis, it is helpful to determine the intrinsic value of stocks and help investors judge the degree of undervaluation or overvaluation of stocks, and make corresponding investment decisions. However, stock valuation is only one aspect of investment decision-making, and investors also need to consider other factors, such as risk tolerance, investment objectives, and market environment. The stock market is volatile and uncertain, and stock valuation is only a reference and cannot guarantee the future trend of stock prices. Therefore, when investors conduct stock valuation analysis, investors should also pay attention to factors such as the company's financial status, industry prospects, competitive advantages, and market expectations, and be cautious about the results of stock valuation analysis. Different stock valuation methods and models can provide different perspectives and references, and make accurate investment decisions on the basis of comprehensive analysis in combination with one's own investment objectives and risk tolerance. In addition, investors should always pay attention to market dynamics and news events, as these factors may have an important impact on stock prices and valuations. Flexibility and adaptability are key elements for investors to succeed in the stock market. What do you think about this? Welcome to leave a message in the comment area to discuss with everyone.